the minutes from the last meeting.
That a motion was made and seconded to approve the pension application. I think we have to identify who made the motion and who seconded it. Because she could have made the motion, that's the problem.
You're right.
So I'm pretty sure I made the
You made the
motion, I
motion.
think Jim seconded it.
Okay.
So we can correct the minutes to reflect that.
Yes, there should be names there, correct.
Okay.
Yes.
With those changes, there is a motion.
I don't think I was in the second, I wasn't
You weren't here.
here. It says I attended.
Okay,
You were here in spirit.
I tried to get here. No, I was on the road with my son.
all right, with those changes noted, I make a motion to approve the minutes.
Second.
All in favor?
Aye.
You want to discuss this one application?
Sure. So one food service application, Gladys Messy with the Board of Education. She's a cafeteria worker. She's been with the Board of Ed for 20 years and 7 months. Her commencement date would be August 12th of 2023. This is an early pension and she took the standard option. So request approval of this pension application.
I have a question. I was looking, her contribution was $14,900. And in 1 year, she'll get $15,900. Okay, now, the other two pensions for the city, one's been here longer, so they've been putting money in earlier. And his contribution was 101,000, but he's getting only 53,000 for the year. And then the Masa, she contributed 47,000 and it's only getting 23,000 a year. That seems like a real discrepancy.
So I can look at
What was their years of service?
Palasa.
What was the years of service on the other two? But Messy,
30 years, one of them
One
was.
was 31 and one was 17, so they're kind of in the
Yeah.
midpoint of the two of them.
So I can speak to, and we could, the first one with 31 years of service, there's a qualified domestic relations order. So an alternative payee is receiving some of those funds. That's the reason why the amount is different. So with the qualified domestic relations, we split it into two. So that's the reason for the distinction with that pension payment. It's reduced by the amount the alternative payee receives.
Can I say something? I think because the pensions are done on a percentage and a cafeteria worker earns a lot less money than the man that's making $100,000. So the percentage that comes off is going to be less money than what his salary is.
Okay,
That's true too, yeah. But for the first one there, I just wanted to know there was a quadro related to that as well for the.
Okay.
it's a motion to accept this pension.
Yeah, I move we approve the pension.
Second,
I'll second
all in
Aye.
favor, aye. Opposed, no. Is there a motion for adjournment?
So
Motion
moved.
adjourned.
Second.
Second.
You get your chance. The new
Second.
guy gets it. New guy. Motions for adjournment. And since you weren't here last time, you can second it. All in favor? Aye.
Aye.
Opposed? No. Excellent. Look at this, we're so far ahead that we might have to, look at this, right on time, 6 o'clock. Regular pension, call the meeting to order and seek approval of the minutes to the last meeting.
The same comment that I made about the minutes. The motion was made and seconded to approve the pension applications. Again, I think I moved and
You
Jim
moved and Jim
seconded.
seconded,
And I wasn't here.
and you weren't here.
Right.
Again, it's spirit.
Isn't the last for you to wrong? Right,
We're gonna make those changes. to
yes,
the minutes.
I just wrote myself a note.
Okay?
Yeah.
With those changes, motion to accept the minutes.
So moved.
Second, all in favor?
Aye.
Passes unanimous. Is there any public comment? There's no public comment. Go to the approval of pension applications, which there are two.
We have two pension applications. The first one is Joel Grant. He was the DPW Fleet Services Manager. He has been with the city of Norwalk for 31 years and 9 months. The commencement date of the pension would be September 16th of 2023. This is an early pension, and he has selected the standard option. And Palasa Kiria, I will say her name wrong. Kyrikides, thank you, sorry about that. Tax assessor's office. She was the administrative assessment clerk. She had been with the city for 17 years and 8 months. The commencement date is October 3rd of 2023. She's taking a regular pension and she selected the standard option.
Any questions on this, Richard?
It seems okay, I move we approve all.
I'll second that.
All in favor? Aye.
Aye.
Opposed? No. Excellent. Performance review.
Good evening, everybody. Rich now online, so we'll take a look at I believe it's the second section. I think the first one might actually be the Empower presentation. So behind the first tab there is the August report. So just high level, August, we did see some volatility creep back into the market. Global equities and bonds were actually both in the red for the month. We had some concerns around China's economy once again, as well as some upward pressure on rates. And last but not least, we actually saw Fitch Ratings downgrade sovereign credit rating for the US, if you recall that earlier in the month, which was kind of crazy. But nonetheless, consumer sentiment was pretty negative as a result of those, as well as most investors really believing that we probably see one, if not two more rate hikes in 2023, and most likely a couple more in 2024. S&P 500 finished down 1.6% for the month. MSCI EAFE was down 3.8%, and MSCI EM was down 6.2%. So on the first page one here, just looking at the actual market values, as I just mentioned, market was down. So not surprisingly, along with a cash distribution, we did see the market value drop from the July 31st level. If we turn and take a look at the actual performance on pages 2 and 3. So just a reminder, the first column, fiscal year to date, for those who just may have forgotten, fiscal year starts on 7/1. So this is a 2-month time period we're looking at in this column here. And over that 2-month time period, the total fund returned 0.65%, which is 24 basis points over the custom benchmark for that same period. And that puts the total fund at 8.77% for the 1-year period. That's 64 basis points ahead of the benchmark. This is on page 3. And then for the 3-year period, 5.19%, 70 basis points ahead of the benchmark. Frank, are you following me there?
Your handout is
Yeah,
not,
your handout is
is
different.
different. It doesn't have, is the July, I believe, in here.
We had, yeah,
That doesn't have the August in here.
we had July.
Are you guys in a
That's what-
different
And we are in the,
different tab? I
under the
apologize.
tab
Maybe our assistant compiled them differently.
August 1 and tab 1.
Oh, tab 1, that's what I meant. The first tab. I'm sorry.
right.
I misdirected you.
Wondering how
Yeah.
we made money in the down market.
Second section behind the first tab. Yeah, apologies. Okay. Interestingly enough, while for the fiscal year to date period, again, the 2-month, July and August, on an absolute basis, US equities were the biggest contributor, but on a relative basis, the largest contribution actually came from the international equity side of things. If you look at the just a little bit down the page here, international equity returned 0.37%, but is up 95 basis points over the MSCI ACWI ex-US index, and that's on page 2.
Yeah.
And the contribution came from all the sub asset class areas. So developed markets portion outperformed by 114 basis points, EM outperformed by 31 basis points, and global equity long short outperformed by 15 basis points. So really good to see that the active managers in this space are adding value as we would hope on the that net of fee basis. The other relative contributor for the fiscal year to date period was actually real assets. They provided a 27 basis point outperformance versus the the benchmark there, which is the Bloomberg US Tips 1 to 10 year.
Any, insight on what happened with Walter Scott?
So Walter Scott, shorter time period. I did have some commentary, you know, it's through September, the commentary. They said really the largest detractor for them was from the geographic perspective. So their Japanese holdings actually lagged the benchmark counterparts. And I think they just had a little bit of a security selection issue within Japan, which is the biggest geographic allocation of their portfolio. They did mention, you know, that they had some other detractor with specific names. Daikon Industries was one, and Fanuc both had macro headwinds, and also lower exposure to what they called the more resilient financial sector on the international side. That was another headwind for the portfolio during that 2-month period.
But we had them for the whole 2 months, right? They were.
Oh, yeah, correct.
And Jim, I might add, just if you recall, this is really a quality growth portfolio with an emphasis on quality. So, and they're a very low turnover strategy, less than 10% typically on an annualized basis. So what we've seen in 2023 is really, especially in the US, a low quality rally. We're starting to see more volatility and see quality come back into favor, but you know, their emphasis on fundamentals, cash flows, and future longer term growth is really the key facets of their strategy and has really not been in favor in the markets.
Yeah, okay, thanks.
Interesting kind of side note, and this plays out in the numbers here, but I was just listening to a podcast the other day on my way to work, and they were talking about, they looked at a attribution 3-year time period as of the end of September. And in that 3 years, value using the Russell 1000 value is up 30%, where the Russell 1000 growth is only up 24%. So even though everything we've heard in the last 10 months anyway has been all about, you know, the growth, in particular the tech names and the Magnificent Seven, the reality is a lot of the rest of the growth index has been flat to down. Meanwhile, value is just kind of slowly chugging along and has produced really well. And so we're seeing that with Silchester, who's a value manager on the international side, as well as LSV on the domestic side. Both have had really strong relative and absolute contributions in the last 12 months. So that's why we diversify the portfolio, right?
Yeah.
Yeah, what about this one, 3 years, these bonds?
Oh, jeez.
Yeah, it's a historic, that's kind of the next conversation that Britt sent the email about, right? Which is kind of a continuation from the last around, you know, thoughts about a 3-year
I'd like to
CD.
comment on that.
Yeah, absolutely.
Couple of things. First of all, one of the things is if you bought CDs, they're guaranteed, you only lose 3 months of interest if you decide to cash them in. So there's no principal risk, which we've seen to have a lot of principal risk. Second of all, the idea of only having $250,000, JP Morgan sells CDs that I bought, and I'm comfortable being above $250,000. And I think that if JP Morgan failed, we wouldn't have pension board meetings, because that would be about the end of it. I think you would agree with that, right? And also Silicon Valley was made whole on all their deposits,
Yeah.
right? And as far as the bonds, like it was mentioned how like, well, we could miss some of the idea that in 2020, the bonds went up. The Federal Reserve went from 4 trillion to what, 9 trillion on their, you know, on their holdings. So, I mean, when you're buying $5 trillion worth of bonds are going up. That's all there is to it. But that was because of COVID and because of the lockdown and everything else. So, you know, I think that at some point, and oh, by the way, and if you listen to the minutes of the last meeting, one of the things was that one of these, in one of the 2 funds we have, they extended their maturities, which wasn't maybe a good idea. And because these numbers are for August, from August to September, the long bond is, the 10-year treasury lost another, what, 80 basis points. So that means these funds are just even in worse shape. And they've just, been pathetic for a long, long period of time. I just believe we had a bull market for 40 years in watch. They really did badly. And I do think that we should maybe, and a bank, if they have, like, if we had a portfolio of bonds, rather than mark to the market, like banks don't mark bonds to the market, and it would just simply be, you look at, say, A corporates, single A corporates yielding 6.5%, then we would have that $60 million producing 6.5%. And you could do it as far as have a ladder where you say started 2 years ago up to 10.
And then you're saying not mark to market?
You could if you wanted, but you're gonna take them to maturity.
CDs
No,
are not.
no.
Okay, even mark them to the market.
Yeah. I
All
mean,
right,
That's the
yeah.
problem.
These guys are
CDs
market to the
aren't,
market.
CDs aren't marked to market.
Well, I know, I just said bonds, I said corporate bonds or
Right,
something.
right,
like
but
that.
I think that's. All right, so maybe Britt and I can just, playing devil's advocate for the sake of this discussion. I don't know that I would take the route of JP Morgan never going under, because, I lived through those Lehman and Bear Stearns days, and I'm pretty sure prior to that, everybody would have thought, no way those banks go under and the economy or.
JP Morgan might be 10 times larger than that.
All I'm saying is from a fiduciary perspective, I don't think we're, or at least from our side, we're in the position of, making those types of let's really play it from a risk perspective side of things. And the same thing we talk about $250,000 from the FDIC insured standpoint. I think that just from our side, we would always, err on the side of caution.
Do you honestly think JP Morgan could fail?
Well, let's separate the argument.
Right.
Is, let's say, okay, so we're saying to, instead of putting our fixed income into these bonds funds, let's shorten the duration and go for fairly short maturities.
No, I said put a ladder in.
Well,
2 to 10 years.
but why?
But you're locking up and there's
Yeah,
little,
why not just buy treasuries then? And this whole argument
Then buy
of taking
treasuries.
credit risk goes away. And so that, to me, the first decision is to decide whether we just go out and buy a bunch of bonds, do it with taking no credit risk and be done with it. But I mean, don't we have the same amount of, how different is our fixed income exposure going to be in taking that approach versus what we're doing now?
Well, the performance, I guess, the thing is now, one of the things is this, we have a bogey of 6.5%. So we can put some of our money into say 25% of our money, or 20% of our money into a fixed income investment we feel is very secure, that would yield somewhere around 6.5%. Then what we're doing is we're like
Oh, I understand
taking that exposure.
The
away.
assumption is that we're holding it to maturity, so therefore
Right.
there's no risk, basically,
Right.
because you're gonna get, you're
well,
guaranteed.
there's risk, but-
There, you still
Well,
have.
even if you did have treasuries, if we think that treasuries are risk, then
But see, the difference, again, you kind of alluded to it earlier, is that what you're seeing is the mark to market prices for something like a treasury or any other daily traded, right, versus a CD that's taking that out of the equation because they're not mark to market. So it's almost like private equity in that regard, where they get to hide any sort of volatility that may occur in the interim, and all you're gonna see is that guaranteed right at the end. Now, like, there's also, and we talked to our head of the fixed income team about the fact that there's little, very, very little secondary market to trade, these shorter term CDs. So it may not always
You don't
be
trade them. If you wanted to cash them in,
right.
you could. So there's no capital risk.
Yeah.
There's no capital risk. Do you agree with that or not?
Oh, yeah, yeah,
Okay,
yeah,
thank you.
absolutely.
Frank, I don't think fundamentally, I don't think we disagree with your thought process. I think the implementation of how you go about that is where we divert. From a fiduciary perspective, the board buying and selling individual securities is a fiduciary risk, in our opinion, and not something that we can consult to because we're not registered to. We have seen, as I mentioned in my emails, some clients create customized portfolios with managers to really hone in on exactly what they want and how they want to implement. And that may include CDs within the portfolio, but hiring a portfolio manager to do it so that the board does not have the risk of buying, rolling, or selling individual securities.
Are there funds or are there managers who just do CDs?
No, they do CDs as a portion of, you can have a separate account and they'll,
But listen to what you're saying. I mean, if the Fed is gonna raise rates a couple more times, and every report I've read over the last couple of months says they're expecting the rates to be at least this high, if not higher, for a couple of years.
right,
Seems
but,
like
But CDs don't help in that environment.
right, you're locked
You
in.
gotta take, if you're worried about rates rising, you get out of bonds and you go into cash and we buy a bunch of bills. And that's where we put our cash and once we think that the coast is clear, that the rate rises are done, then we go out and buy some fixed income funds again. And that's the strategy. It's
How to do it.
But there's two components there. One is that everything we just talked about in the last 2 minutes. Those are tactical decisions. Like, we think the Fed might do this and rates might go here, up, down, sideways. Nobody at Callan, or I would think in this room, can predict that. And so now you have to get the exit point right, you have to get the re-entry point right. And then secondly, and because there's no other clients, and we actually asked firm-wide about this, that are utilizing individual CDs. There is 2 clients who are buying shorter term treasuries, like 6-month treasuries. However, in that situation, there are individuals on the investment committee who run their own asset management firms and have their traders handling that for them and doing the actual roll forwards on the 6-month treasuries. That's a very active position, and you have to be comfortable from a fiduciary standpoint, because to Britt's point, Callan, we're not in a position to do that. So that would be on this body to decide who's going to handle that. If it's somebody inside of the city office, and you have to take on that fiduciary responsibility in addition to everything else.
If we held treasuries, would we need to mark them to market or not?
In the interim, they're going to get marked to market.
Our
for sure.
intention was to hold them to maturity.
Right.
I have a real problem with the idea of, because we're holding maturity, we're putting our head in the sand and we're not gonna see the volatility, we're not gonna mark the market.
You'll see the volatility.
That is
Do you think
from a risk management point of view, that is just
do you think
hide behind because we're holding it to maturity.
Okay, so fine, we marked to the market, but how much do you think a 6-month CD is gonna go down? And if a 6-month CD went down, how much would a bond portfolio go down?
It's all depends on duration. So what I'm all fine and good for us arguing that we should shorten our duration and let's find a fund that has a shorter duration, the shorter maturity, and move some money in that. I think that's a fine decision. And there are, I'm sure, Callan can find some funds for us to approve, that we can do that we can, Vanguard's got, plenty of funds that with maturity, my target maturity, 6 months or 3 months or 12 months or 24 months, whatever it is we want to do. I think that would be a way of shortening our duration that's consistent with our investment policy and the way that we run the firm and the board. I'm perfectly fine with that. I don't. We can go ahead and do that.
Should we look at, say, Northern Trust, if they could purchase treasury bills for us?
Well, or we can find a
There are
fund.
so there was one in particular that the head of our fixed income manager research team recommended that's being utilized in the same fashion. So there's CDs are a component of that. They have some treasuries, they have some corporates as well. And you can have a separate account, so you can customize it and say, look, like, here's where we want to be on the curve. We want to be on the shorter end. And they're going to handle all of the tactical elements, right? And
Are there others or just one that you're aware of?
that is he said is the manager that he's seen most recently being utilized. There possibly others. He knows them well and he's comfortable with them from our side of things. So that was the one he mentioned to us.
There are other instances.
And the
absolutely.
alternative,
Yeah.
the alternative is if, for something like that, we would want to have that manager present to the board.
Right.
And so that the board can understand how they think about this and how we could go about creating an account like this. The reality of that is that the
Before can we get
implementation.
some information on them before they present?
Oh, 100%. And I
Get
think,
that.
yeah.
Something like for our next meeting?
yes,
Yeah.
yeah. And I think so, back to maybe the overarching goal that you raised. I think we can achieve that in a more sound process with something like this, and take advantage of the shorter end while, the long side sorts itself out. Because if we go the individual, 6-month treasury route, it's going to be the same thing where those are individual securities that Callan won't be able to oversee. And that would be on this governing body to essentially handle and take care of any trading or rolling forward.
Yeah, be a lot more comfortable with the manager doing it rather than us doing it, absolutely. Okay.
Is a question, why are these funds performing so poorly in this rising rate environment? When you think that they would get some value.
Well, I have numbers like I looked at like the 3-year ag, for instance. And so when rates are rising, this is very hopefully this makes sense, bond prices are going down.
Yeah.
So over the last 3 years, the price return for the ag has been negative 8.6%. But what you have to keep in mind is that the coupon return during that same 3-year period is 14%. And the yield is the largest component of a fixed income return. So the coupon is there. It's just that we are in a rate environment that we haven't seen for decades. I don't know how many decades, but we're talking 3-4 decades, right? Something to that extent.
Early 80s.
Early 80s. And so this is just a very different environment than anything we've seen almost in the last century. And it's being done at a fairly high clip in terms of the increases over a short period of time. So it's magnifying those price.
But what has the duration gone from to, and what is it at now for those?
Well,
funds
we're
now?
in an inverted yield curve, so you're actually getting more yield on the short end than you would on the long end.
Yeah.
Typically, they'll pay you for tying up your assets
Yeah.
over time, so that the curve should just go straight up, and now it's going the other way. And that's the issue that is that there's higher rates on the short end.
Duration, Dave, the duration on your fixed income managers is in line with the aggregate index, which is about 6 or 7 years, give or take. So
Did you
you're a
say
little
that they
longer
ex-
duration than
They-
the short end of the
they
curve that
extended-
Kevin mentioned.
But they extended their duration, but I guess the thing is, you know, look, this is, like, we have a 7-year performance here, and if you went back 10 years, out of those 7 years, 4 of them were in a bull market, right? 3, 2.5, or say 4.5, 2.5 have been a bear market, and they're like, they just don't.
Well, bonds also had their worst year on record in 2022. or the
Yeah,
aggregate.
that's right. So it's,
Yeah, and the 10-year traded at 35 basis points in 2020. How much money did they make then? I mean, you know. And bonds really. I mean, I went out to Chicago in 77 to trade bond futures. And the moves in 1979 and 1980, right? You know, they make this, like, when people talk about, oh, they were such a big move. One time the Federal Reserve raised rates 300 basis points in a single meeting. So when people start talking about, oh, they went up 75 basis points, big freaking deal.
Yeah,
That's when you're starting at 12.
make sure you had the handle right.
That's right. You know,
I think it's just
Percentage wise, the current increases are saying, roughly the
right,
same.
but starting at zero,
starting at zero, right?
starting at zero, going to 1 is infinity.
Right, right.
So is the takeaway of what we want to do here is to find some, to find some, either a manager or a fund that has that have some shorter duration. Maybe someone who will have us something for very short term, a year or less. Something a little bit more intermediate, maybe 18 months to 2 years, and then maybe something out to 3 to 5, and present us with those alternatives and how they perform. Because what do you say our average duration now is?
Six or so, right? 6.5, Britt, something like that. I think is
Yeah,
the
I can
duration
pull it
of the
from the
ag.
2Q report, if you give me a sec.
By the way, the other
Let's,
thing is,
short, well, I'm not
sorry,
quite finished yet. I'm waiting for him to get
Sounds like we'd rather be somewhere like sub 2 years or 3
or
years.
cut it, at least cut it in half.
Yeah, yeah.
And Rich, to your point earlier with Vanguard, if you want to implement this sooner rather than later, finding a passive vehicle, at least as a placeholder, might be
Yeah,
a good
exactly.
option while we can evaluate
Yeah.
managers with more detailed investment guidelines within this space to see if the board wants to go in a different direction.
Yeah, and so I don't think we're actually at this. The greater risk we have is not from somebody trying to earn 20 basis points over the 6 years. The fact that we're at a 6-year duration. And so if we just go passive down into a year, whatever we want to do, ladder it like you want, some at 6 years, 6 months, some at 1 year, 1 at 18 and 2 years. And use a passive fund, we could get that done relatively quickly.
yeah, and that's what I'm looking for, is a passive fund.
Okay.
I'm not trying to say that we're gonna trade.
Mhm.
And one of the things too, is some of these funds, one of the things they're doing is some of them, I'm not saying that the two we have, is one of the things they do is they're long more than 100% and they're borrowing money, and that's what's really hurting a lot of them, because the yield curve's inverted. It's been inverted for a long time, so they're borrowing money at 5% and buying bonds at 4%, and then the bonds are losing value and they're losing money on the spread to boot. So that's why I look at this and I'm saying, and the other reason is this: if our bogey was 8%, I wouldn't be talking about this as much. But what I'm saying is, if we can move to a level where we say, okay, to the city of Norwalk and to the actuaries, and we say, listen, our bogey is 6.5%, and we took this money and we're getting guaranteed virtually guaranteed 6.5%. That's called, for me, I'd say that's a sound investment policy for the pension board. We're not trying to say we're gonna buy bonds and they're gonna appreciate way up in value. We're not saying we're gonna try to buy stocks that go way up in value. Because what we're doing is we're eliminating more and more of the risk to the portfolio by doing that. And that's one of the things as a fiduciary responsibility that we have, is to reduce the risk if we can find our targeted amount of money. And that's what I'm trying to do.
Yep, I like the idea. I think we're all kind of starting, like, we're on the same page now in the last few minutes. I mean, and if we can do that in such a way where we keep full liquidity without any sort of penalties, what have you. You know, if there's an environment where the equity side of the portfolio, the growthier side goes down, and we really don't want to exit, you know, stage left on that while they're down, we can utilize the fixed income, you know, particularly if we're still feeling, let's call it subpar about their performance, then we can tap them in, you know, something like a passive vehicle if we need, you know, cash for benefit payments or whatever it might be at that point in time. And instead of having to sell at lows on the equity portfolio.
Well, you know, if you think about this, one of the things we have, the reason why we have a long short fund is supposedly to balance things out. In a bad year, they're not gonna go down as much. In a good year, they're not gonna go up as much. If we did this with the bond portfolio, we don't really have to even look at it and say, well, in a bad year, they go down, a good year, they go up, or whatever. We're gonna say, we are very close to our bogey. That's it. And if rates go to 10%, we're at our bogey, and maybe we roll up. And if rates go to 2%, we're at our bogey for that period of time, and we're fine. We're not looking for capital appreciation, because these guys, I think, trade bonds, and when they trade bonds, they're not being real successful.
Well, it has nothing to do with them trading bonds. It has
Right.
the fact that the bonds have gone from you know, 1% to 6%. I mean, there's no way you can trade around that. I mean,
Right.
you're stuck.
I understand.
And
it.
so I'm, you know, is that. You know, I just don't want to make the same argument over and over again. So.
A question, Frank, and for you and the others. Britt and I we can work internally in terms of a couple of potential options that you know could bring forward. Size wise, was it your thought that you would do this with the entirety of the fixed income allocation, or is it a portion of it? Just so we can get it, you know, in terms of.
Well, it would be a portion of it, but a fairly large portion of it.
Right.
We have 84 million now.
Right.
What are we talking? You know, down to ladder 40 of it, or?
40 or 50.
Well, we should probably look, you know, do a little deeper drill into the two funds, the two managers we have now. What are they both around 6-year maturity, or? I don't know what.
They're gonna be different, right? Because every manager's and
Yeah.
strategy is gonna have a different take on duration, whether it's worked or not. Like I'm pretty sure Met West is longer duration, Britt.
Yep, happy
Yeah.
to answer that. So as of June 30th, the aggregate had a duration of 6.3 years. Prudential is a core bond fund. They're very conservative. Essentially, think of this fund as a quasi net of fee index tracker. Because if you bought a passive fund, you'd certainly underperform the index just due to fees. And you can see that in their performance. They have slightly outperformed over longer periods. Their duration is right in line. They are heavily invested in treasuries. TCW is really a or Met West is really a complement to them. They're very different. They do have a longer duration versus the benchmark at 7.1 years, which has certainly hurt them in 2023. They will be the first to admit that they made the call of rates flattening out and coming down too early. That being said, when rates do come down the way they're positioned, they should perform well. But they are much more diversified in terms of the type of bonds they own. They own a lot of mortgage-backed securities, a lot of credit, and a lot of diversifiers. And the plus sectors, the higher risk parts of the fixed income market versus Prudential, who's really stick to your knitting, treasuries and a little bit of high quality credit.
Yeah, is there a time that we need to, is, how, if we decide to take money from these funds, is there a period of time, a holding period? And also, by the way, since you're talking about how they get like mortgage-backed securities, which hasn't been a good investment, and the assumption of, it's to me at least, one of the assumptions, and when you buy mortgage-backed securities is how long the duration's gonna be, and because rates are going up, the durations, I mean, who's gonna turn in a 3% mortgage or 3.5% mortgage? So those are, to me, those are even a worse investment. That's my opinion.
Well, the one, TCW is a CIT, Brett, right? I mean, so these should be pretty liquid. They're both pretty big funds.
I don't know whether we have to give them 30-day notice or 60-day
Oh,
notice. That's what I'm
yeah.
No,
asking.
you shouldn't have. Prudential is daily. It is a
Yeah.
commingled fund, but it's daily. TCW, we recently transitioned to the commingled fund in all the portfolios, but I believe it's daily, but we'll have to confirm.
All right, I appreciate that.
So come back, is the kind of request then to come back for next month with a couple of potential options
Yeah,
to review, and then from there,
Yeah.
maybe managers come in and present
right, but I do think we're looking at passive funds,
Yeah,
right?
agree.
We're looking
Yeah.
for passive. funds.
just passive.
Yes.
Well, I think the idea is to find we can make a decision faster on passive funds as a placeholder.
Yeah.
And so, make a decision as far as what duration do we want the funds to be in? Do you want to go from 6 years down to, I don't know, 3 years? And find a combination of passive funds to get us there. And then we can go and evaluate, some longer term managers.
Yeah, or even 6 years to 6 months.
Yes.
Yeah, 6 years to 6 months, something like that.
Got it. Okay.
Okay. Okay. All right, thank you. One last thing. Britt, did you get the thing from Zilt? So, yeah. It's officially,
Yeah.
we haven't got it on the books anyways, but it's officially, there's no securities in it, so. It was good that you took it off a while ago, and that's that.
We were gonna do that with the bonds too. Just so you don't have
You
to-
might eventually, by the way,
There were no further comments from my side on the pension plan. I don't know if there were any other questions about the portfolio or.
I don't think so. If that's, there's no other discussion, would be a motion for adjournment.
Move to adjourn.
Second,
Second.
all in favor, aye, perfect. Now, I'm not gonna call the meeting of the defined contribution just quite yet, so we can have selection, if that's okay. Can you halt the,
I'm sure I can.
is that okay?
I was wondering if this number, this 123, where they do their self, and there's the people that had more money in there. I was wondering if that number there is like a number that's percentage of people, or is it that number there is a threshold where you see that throughout your funds, where people that make above 100,000, have 100,000 in there, they tend to let this, do it yourself strategy more.
You do,
Is there a
I guess I'll
threshold number?
say, at a demographic level,
Yeah.
you find that, investors sub 35 or 40 are more inclined to use target date funds than, because it's been there from the get-go, whereas historically, all the workers do
Let's see right there,
things.
that'd be perfect.
That's what it is.
So it's a little bit of that, right, in the whole, like, onslaught of like passive and everything else, younger investors just a bit more comfortable with perhaps.
With that,
Thank you. So you already have the material.
Sorry, we kept you out there for a little bit.
Today's day and age, you don't get much time in silence to think, right? So half the time wisely. hopefully.
51 million bucks. 45.
Okay, now recording?
We are
We're
recording.
recording, okay.
Do we have everybody back in there or? Can they see
Just
us?
that one.
If you look at the portfolio, it's like 2% in bonds.
Well, the target date fund stuff, the short term one.
No, this is the people who can put different money into their own funds, you know.
2.5%.
Okay. I'd like to call the meeting of the Defined Contribution Committee to order and seek approval of the minutes from January 11th.
Long time ago.
Uh-huh.
I was in here.
I motion to approve.
Yeah, you can't say anything. All in favor? Aye. I guess we should show in the minutes that there's 4 approvals and 1
Yeah.
abstain,
Well, I'm staying, yeah.
okay?
Yeah.
Okay, Empower, you're gonna give a presentation?
Yes, thank you.
Thank you.
Thanks for the invitation. I'm Brendan Walsh. I'm the relationship manager from Empower. I live in Woodbridge, so I'm not far, up the road a little bit. Been with Empower for just under 2 years. I spent 30 years, my career was at TIAA and working with higher ed plans, but I joined Empower about 2 years ago. So we're thrilled to have this plan. We hope we're doing a good job for you. And today we're going to go through some numbers looking at kind of the 2 plans that we're looking at today, and we've combined them to give you a sense of kind of an overall view, which is the 401A plan, as well as the 457 plan. So in front of you, and thank you for whoever compiled that and put it together, is what we're looking at. So if you look at the list of plans, this is on page 3, I believe.
Yeah.
Okay. So if we look at the plans separately, the 457 has about $43 million in it overall. The 401A plan has, let's see what I put in here. The 401A plan is
17.
less about 14 and a half or so.
Well,
Million in that.
Participating assets is 60 million, so wouldn't it be like 17?
Yeah, I have a further breakdown, one of the last pages here. Page 39. The average balance. Yeah, 15 and 45. Yeah, 15 and 45, and this is as of the end of August, just so you know. The September numbers will appear probably next week sometime, but we ran the latest data that we have, which is at the end of August. Now, we could have run these plans separately to get a look at them, looking at the voluntary deferrals into the 457. If you want to look at it that way, we'll be happy to run the reports that way. We usually think that if you have a 401A and a 457, you want a comprehensive view of the overall plan. So as of 8/31, we had $60 million overall in the plan. Again, that's up a little bit from 12/31/2022, where it was 55.2 million. Combined participants, adding them together, we have 1,102 participants in the plan. And that's 995 are active with a balance, 117 separated from service with a balance.
Where's that plan assets number?
That is usually like a forfeiture account is when folks leave before they're vested. That money gets returned back to be used for offsetting future contributions. It could be paid for invoices like services provided to the plan.
Of the 1,100, how many are, active employees in the city that are, in the defined, contribution plan, do you know?
Yeah, we're showing about 995. Oh, in the defined contribution plan, I've got 659 with a balance in the 401A.
Is it that many in the city now?
We have about 633 full-time employees.
Right, but I mean, in the defined contribution, not defined benefit. I mean, what I'm saying is, there are people, you're on defined contribution.
Yes.
There's a number of people here who are still on defined benefit, and I'm just curious how many people are actually
Yeah, we're showing,
into defined contribution.
we're showing where the plan that gets the employer contribution that replaced the defined benefit plan for anybody after 2012.
Yes.
2012, right?
We're showing 659 individuals with a balance
Somebody
in
could be
that
in,
plan.
somebody could be in both.
Yes.
Okay.
Looking at the next page with the executive summary, this is looking at how folks are allocated. 72% of the defined contribution plan participants are allocated to the target date series. I believe when the plan came over to Empower back in 2020 or so, the default was the target date.
Yeah.
So as people were mapped over, folks, you have more of this history than I do, but it's, so it's at 72.8%. And contains about 43.6 million in the target date fund. The smallest category is bonds, which have 1.5 million in the bond category.
Could you say that again?
The smallest bonds with 1.5. Am I supporting somebody?
But the target
Somebody's point of
date,
view?
the target date funds have fixed income in,
That the bonds are 2.5%. Okay, thank you.
they do,
Especially the shorter ratio ones.
Right,
right?
they're smaller than cash.
The returns are doing very low in the short duration.
And then we categorize the investment strategy utilization into 3 categories. It's do it for me, help me do it, or I'll do it myself. Working backwards, the do it myself are the people who say, I feel pretty good about these investments. I understand how they work. I'm going to select the investment portfolio that I'm going to invest in from the available funds, and I'll do it myself. The help me do it is the target date strategy. And the do it for me is a managed account solution where people are saying, I want this portfolio managed against the risk tolerance that I have. I want it rebalanced, and they're willing to pay a fee for that.
What's the fee?
The fee is 50 basis points on the first 150,000 that we're managing. And then down from that for every 100,000 on top of that.
And that's an option that we offer to the city employees.
It's available to the employees in this plan. And they have to opt into it. It's not something they default into. They have to select it. We do have an advice service, which is a free service, an online advice for people who want to go and select the investment portfolio themselves and have the advice model done for them, but it doesn't rebalance. They have to come back and do that as frequently as they choose to. We would recommend about once a year to do that. Now, the average balance that we're showing, combined plans, 54,048, again, at the end of August. And that breaks down, the average in the 457 is 98,784. The average in the 401A is 22,950.
And just so the board's aware, that's pretty typical when a 457 legacy plan has been in place for many years. And the 401A plan is very new, much younger employees going into it. So that's pretty typical in the industry.
You know what, Britt, didn't target date funds, weren't they usually large? I mean, did they come down quite a bit?
These,
No,
In terms of performance.
no,
in terms of
the number of
selection of
people. 'cause
You'll see,
I remember
Frank, you'll see
we
in
were
the
in the
performance
high
report.
80s.
So the 457 plan, and this is also pretty typical, is more heavily invested in stable value. And since the transition to the new investment lineup, we have seen participants actively change their investments away from target date funds, which again, that's a supplemental plan. A lot of those participants have a DB benefit. And we typically see higher allocations of stable value. But the 401A remains very high.
Okay, and on page 6. The lifetime income score. One of the things we look to kind of measure the success of a plan is what type of income replacement folks who are in this plan can expect. And generally, the goal is about 75% replacement income from your retirement plan. So the Norwalk plan is looking at about 68% as the lifetime income score. The way to improve that certainly is to have people contribute more and defer more into the plan, higher investment returns and things like that. But that's just it's a target we look at, and that's why we tend to combine these plans when we look at it, so you get a better view of kind of the comprehensive lifetime income score. Now, if you have people who also participate in the defined benefit plan, that's not included in this.
But also don't city workers, they get social security, right?
Yes,
Yeah.
not police and fire, but yes.
Right, so that would,
But they can input that, they input
Yes.
that. in.
you
You
would
can
put that in the
input
68%?
Correct.
Okay.
So you can
Security's figured
input,
into
I
this.
think you can input also other sources of income,
That's
all
correct.
that stuff, so.
Right.
So they see this score.
They see this score. When participants log on to the web, they will see what their replacement score is, and it will encourage them to. Do you want to change what you think your retirement date might be? Do you want to model this using a higher contribution rate? Increase your contributions, things like that.
And what's the 6% then? What's that, the next thing?
That's saying 6% people have met that 75% goal. So the average is saying the replacement would be 68% of of their income. 6% of people are over that 75% of that replacement ratio.
49 out of 874 are at that point where they can have 68%.
And you'd only be there if you're like 30+ years of service, or 35 years of service, or 40 years of service, that when you hit that goal,
But this projects ahead,
it projects ahead, so that's.
yeah, correct, so it's not good.
People aren't saving.
That's
enough.
terrible, yeah.
Not saving, right?
You know how that compares to other clients of Empower that? It's about the same. Is it really about the same?
Yeah, there's.
Good. We're headed for trouble in the country.
So yeah, taking a look at the next page,
You know, one thing though, going back to this, remember, there's a lot of people who are like 30 years old in this plan. So that, I mean, I know it's still a really very, very low number, but the active employees here now, they might still be working for another 10 years.
Oh, I know, but this number projects ahead. It says based on your,
Age.
your
Yeah.
income, your age, your asset
Oh, okay.
allocation, you were projected.
Oh,
Is
this,
it?
this is your screwed.
Yeah. Exactly.
Oops, that's why I don't like
Yeah,
that
if
machine.
you're 30 or 40 years old, let's say you're 35 years old, I mean, if you're contributing, like the correct amount, what's the correct amount? What percentage would that be? Would it be like 8% or 10% of your salary, or is it like?
Britt, you wanna comment on that, or do you have a thought on that?
Is it
Say
the
it's
average
5%.
deferral rate?
In terms of if you're looking to get to a replacement ratio, what's the average somebody? I think it depends
It all
on their
depends on,
salary,
yeah,
it
how much
depends
you-
on how they're invested, cause it
Right.
looks into all of
Your
that.
monthly costs, right? Like you
Probably need to be like 15%.
have a big house, a lot of cars or not, or do you live like a pauper, right? Like it all totally depends.
And there
Well,
are.
then
There are ways that you can, at least the 401A, where you can create auto escalation. So for instance, Callan's 401k plan that Kevin and I are invested in. If you are contributing under 10%, the plan will automatically increase our contribution 1% a year up to 15% unless we opt out. And what that encourages is higher savings rates to try and achieve that goal of, with Social Security, can you retire when it comes to term? So there are avenues that you can try to help the population increase their savings rate, because the reality is a lot of people log in when they sign up, they're in the target date fund and they don't look at it ever again. And they don't see the 68% or see how poorly their savings rate is versus peers or something like that. So I don't know, Brendan, if you want to touch on some of those levers that other
Do
plans
we have-
do have in place.
As a board, do we have responsibility to encourage it or change it or do anything, or just,
No.
it's not our job?
No,
That's,
it's not our
that's,
job.
that's your job, and in terms of,
The city right now, I don't know if you know this, what it is, everybody from 2012, except for a couple of janitors, they were continued on to defined benefit. The city matches 5%, and if you get a job here, you have to put in 5%
Yeah,
into
yeah.
retirement, and the city matches it. It does seem like a lower number, but again, that's not our.
not our job, not our
Right.
job.
That's not our job.
Maybe we advise you, you may want to act on this.
Yeah, and part of the Empower service is we have representatives who will meet with the plan participants. Go through these, look at these allocations, look at how much they're saving, encourage them to put more away. And one of the first things that folks see when they log into their account is this replacement ratio, and it's kind of allows them to play with it a little bit and see, how do I increase that? How do I improve my chances of replacing my income at retirement?
Do people get, do participants get messages on the system that, you know, you're not gonna get there at this rate?
Not that you're not gonna get there,
Yeah.
but just here's what it projects it to be. And we don't wanna beat people over the head that, you're failing, but
Mhm.
and we do targeted messages throughout certain campaigns, save more. Look at your asset allocation, things like that, retirement income, all of those messages are part of the service that we provide. Okay. Just on the next page, page 7, just looking at, you've got on the right-hand side, 8.7% of your population contributing over 10%. The average contribution rate is 5.9. And that's slightly down from 6% where it was on December 31st of 2022.
And for most of these employees, they should be in the 12 to 15% range
I think that's
to get there.
an accurate statement. Yeah.
I mean, the thing about this though is there's a number of people who they can still contribute or they can be in the defined contribution plan
Mhm.
and still have, like be in 457 or something, so
But they can. put that in.
there's the number 821 is not the city workers that are in this plan. You know what I'm saying?
So when you refer to a defined contribution, both of these plans that we're talking about are kind of defined.
Right, but one's voluntary.
One is voluntary, that's a
And-
457.
Right, and it could be, somebody could be in both,
Almost, right,
right, and somebody could
doing
also,
5% into the 401A,
right,
and then anything additional above the 5% would be in the
but there are
457.
some people even who are retired in this plan,
Yeah.
right,
Yes,
who are defined benefit people who also are in this plan.
correct. Use this as a
So that's
supplemental
why
savings.
sometimes if you're retired, probably not contributing much to the plan anymore.
Correct. Right, if you're retired and not earning an income from the city of Norwalk, you can't contribute to the 457.
And in
It's
fact,
done through,
right.
it's done through salary.
wasn't there a drawdown that was quite substantial, actually? The next page, disbursement of $5 million.
$5 million. Right, and we could take a look at that if you want to see what the actual distributions are. I'll direct you to page 17. 16 and 17. So 16 and 17, look at the distribution activity. The majority of them distributions are going to be people who have separated from service. They've met their triggering event and now they're taking the money out of the plan, whether they're taking out for income. They're moving into an IRA, what have you, that's where you see the largest number. And if you look at it, I was just looking at it earlier, the next page will show that it's fairly consistent month to month. So September of 2022, in terms of participant numbers, not asset size, but 11 individuals taking a separation from service distribution in October were 12, November 8, December 6. January was 15, 13, 8, 5, so it's fairly consistent. And then, of course, you have your RMDs, required minimum distributions.
14.
Might have some depth in there, and obviously, you could have a situation where divorces, all of that would fall into distributions there. Yeah, but it's not unusual. People get to retirement age, they meet a triggering event for separation from service, and that's where very often it's hard to retain those assets in the plan because they might be working with a financial advisor or somebody who is encouraged them to move funds out.
Excuse me, I have a question. When you were talking about the 401A and the 457 and people can join both plans, would that be that in the 401A, if they contribute to 5%, the city would give them 5%? Would they also give them 5% for the 457?
No, the way the
Only
plan is.
once.
Correct. The way the plan is, the employer contribution is the match to the 401A plan. There's no match to what goes into the 457 deferred compensation.
Okay, thank you.
You're welcome. Okay, page 10, just in terms of participant balances, I thought this was interesting, and this is not unusual for the plans that we work with, government plans that we work with of this size. The majority of the plan participants, you see, the average account balance is anywhere between 0 and 25,000. Usually what I do find though is on the far end, it's like a barbell curve, is that you do have generally have a higher percentage of the people over 250,000, which sometimes around 10% or so. So I don't know, again, could be that this plan,
So young.
younger population, it's a young plan.
Well, and you just told us that most of the people that separated from service withdraw.
Good point.
That's where the 5.2 went out, so that's why we don't see the bar go out.
Good point.
I think the other thing is, if somebody leaves before 5 years, they're out of the plan. I mean, it's not their option anymore, I think.
The best thing is 50% after 1 year, 100% after 2 years.
Oh, did they change that?
Yeah, so the 5 years was the pension, so it's 50% after 1 year, 100% after 2.
Right. So after
They're vested.
2, the employee is always vested in the 5% they put in. The match after 2 years, it's theirs, it remains, but if they leave before
It
the
used to
2
be 5 years.
or the 5 years.
Yeah.
We went through the investment strategy utilization again. There's a lot here on the investment strategy utilization, but a sense, as we said, most of the folks are either in the target date or doing it themselves. Contribution activity on page 14. The majority of the contributions that are coming in are before tax. There is year to date, 125,000 gone into Roth contributions, so the employee has the option of contributing on a Roth basis. We like to see younger employees do Roth, right, for the benefit. They don't need the tax break now. They could use it at, tax-free at retirement. And then we've got the employer contribution coming in, and other could be rollover. So the plan allows people to roll over prior employer retirement plans into this.
I apologize for going back, but on page 13, so you had talked about how you would do it for me, help me do it myself.
Mhm.
So you have to do it yourself, it's 115, targets 823. What is the do it for me number?
The do it for me is that managed account solution, the one where people are paying for.
Right, but what is the number of participants doing
Oh,
it?
that would be 56. That's called My Total
Okay,
Retirement.
that's why it's called, okay.
My Total Retirement, 56 individuals represent 5% of the participants. And the average balance, you can see the average balance. The average balance for the do-it-yourself strategy, again, is higher. Not unusual, right? People who have a better sense of how they're investing and how the investments work tend to have the higher balances. And then the my total retirement is the next group.
Thank you.
Okay, you're welcome.
Say that again, the people, is that? The people who have a better sense of their investments have higher balances?
The people who are the do it themselves, the people who do it themselves tend to feel more confident in their ability to invest the dollars.
Got it. But that's not necessarily why they have a higher average.
No, I
balance.
mean, there could be a number of factors,
Yeah,
but
okay,
older.
okay. There's probably more demographic there. Okay.
yeah.
Although if you notice, there's only 2.5% in bonds.
They're missing out, Frank. They should lock in those rates while they head to retirement.
And they never mark to market.
Yeah.
That's
Are there other things that you're interested in knowing? I mean, we have all sorts of reports we can slice and dice and take a look at.
What do you, what's your sense of what the participants are calling about?
Hmm.
You know, questions, issues.
Well, I think, and Kevin and I were talking about this a little bit earlier, before the meeting was, we're getting a lot of questions from people, I'm not gonna say for this plan, but in general about, boy, when I look at what interest rates are doing in the retail market of, I can get 5% from a money market account, how come I'm not getting that in my plan? Type of thing, right?
stable value is usually, right, like the people that have stable value, but there's a short-term effect right now. Where money markets are gonna outperform.
Nobody was complaining about the fixed rates, when they were getting fixed rates and it was
Right.
zero, right?
Yeah,
But
right.
now that they, like.
Plenty of that work.
Generally the calls tend to be about what my options are.
Okay.
Again, with a high percentage of people in target dates, I agree with what Britt's saying in terms of, people will contribute and then not think about it. And essentially that was the design of a target date strategy. So people weren't just putting it in a money market account and leaving it there for 30 years.
Yep. Right.
What do you do when somebody is hired by the city? Does somebody come down and meet with them to discuss this?
Depends on the need. Depends on the need. We make ourselves available to do that. Usually, that'll come from Tina's office to say, we'd like somebody to come down and meet with some of our new participants, our new employees.
On a typical basis, I'm sorry, I didn't mean
No,
to-
go ahead.
when they're onboarded, they're provided with, the instructions on how to log into the portal and information about the plan. And then the employee will typically, kind of dictate whether or not they want to meet with a representative or whether they're comfortable with signing up themselves.
And there's no charge if they meet with a representative?
There is not.
Okay.
The only time people will pay a higher fee is if they want that managed accounts service.
Do you have that question on the?
Well, the one thing we were talking about was, the communication between when someone goes into the portal, we were discussing, the employee that we just dealt with
Right.
this week about, and we went in and made the change. And I met with Karen Titsme to talk about a way in which maybe we could,
Make that a little
make that a
sooner.
little.
Yeah,
Yeah.
I don't wanna,
Lead time.
if you guys have spoken about this already, but it's governmental 457s. Basically, you have to declare that you want to defer or make your change essentially a month in advance.
Yeah.
The Secure Act 2.0 is good, getting away with that, doing away with that for 457 plans. So now it can be as soon as reasonably possible. And I would think that that's something we wanna put in place.
Yes,
It's a voluntary choice for the plan. Okay. And then RMDs are moving up to age 73, eventually to 75. One of the big things, and you guys may have covered this, that had plan sponsors concerned was that the catch-up provisions under for anybody who was earning over 145,000 was saying it had to be done through Roth. A lot of the plans, government plans, don't offer Roth to employees. So there was some concern that was supposed to have to be done by 2024, by January 1. So a lot of the plan sponsors contacted essentially the congressman, and then that has been pushed off to 2026. But the fact that you guys already offer Roth, you would have had that source available for the catch-up provisions for anybody over 50.
Eileen, Eileen? I
I'm mute.
Yeah,
Yes,
yes, I was wondering, because, you know, you deal with a lot of people who work here. Do you hear any comments that we should look at, or you would like to express to the gentleman here? You know,
well,
that are they pleased with it or not?
I do hear, the only thing that I've heard recently is that some people are confused, very confused. And they would like to know who they can get in contact with, because I tell people they do receive statements. Is it quarterly statements? Because I tell them it's quarterly statements on their accounts. And some people
Yes.
are telling me that they're not receiving any statements at all. So now that I'm hearing this, Tina, I'm going to be referring some people to you, okay? And that's the only other thing I hear, and I just think that they're confused. You know, I don't know if it's the wrong address that maybe they had put down, and that's why they're not receiving statements. But you know, I will make sure I refer that person to you. But anybody else, I hear no problems at all. Really,
When
Good
it-
to know, and it is quarterly statements, yes,
yes,
we're
that's why I
required.
thought, yeah.
Quarterly statement,
Can people request paper ones?
yes.
Okay,
The preference is through electronic delivery. That is the preference. And in fact,
96%. You're
Yeah,
getting
yeah.
electronic.
yeah, I mean, that
I've
was,
done
that was something in this, and thank you for bringing that up, because I was gonna brag to you folks about that a little bit is, to have a 96% email capture rate is fantastic. And that helps us keep our costs down. I mean, if you look at what it costs to send something in the mail today,
Yeah.
to have to do that through quarterly statements. So yes, we prefer to do everything, regulatory mailings, and everything electronically. But people who aren't comfortable with that can opt out and get things on paper as well.
and is that easy to do? I'm just curious.
Opt out, very simple, but they have to go on the website to do it, right? We lead them to the website in order for them to do that. Now, they could write us, and if they really are, you know, do not like the comfort of the website, they could write us and ask us to send it on everything on paper.
And one of the things that the city, I think in general plans to do is, I think prior to COVID, there were obviously a lot more educational sessions and information. And obviously COVID has had kind of stopped those kind of annual things. So we're in the process of working with Empower and some of our other vendors to either have some kind of benefits fair or monthly information, maybe where we highlight a certain benefit that the city offers and to provide some more education. So we're working on that at our end. We understand that we need to do a better job to kind of start to ramp that back up, to both allow the employees to understand what benefits they get, but also for them to understand, things that maybe they can do on their own to help with, especially in this case, retirement.
In some ways, this whole notion of people doing what the defaults are, it is a very strong incentive, or a very strong kind of factor in actually them stepping up and doing these things. I wonder whether should the defaults really be to the 100% level, as opposed to being to some level below 100% of that, that slide, the lifetime value, or it is.
75.
That's
Yeah.
kind of what Britt, I think, was like that auto escalation
Yeah.
feature that you talked about.
Exactly. If it was, wherever that number was, it was, if it was 100%, or you're gonna make that target, that was the default value that you've got every year. And then we let them change it off of the default value. So this number here is this number here would be default to the 68% to a number.
With the idea being that you change it in small increments such that they don't even
Feel it.
necessarily feel it or notice it. Right, right.
Your model, in terms of projecting retirement income percent, that has assumptions for inflation and social security payments and all of that stuff. Are those assumptions?
And individuals can change that.
Oh, they can.
They can go in and change
All
that.
right.
That's pretty sophisticated though, for people to do that.
Yeah, but they're pretty important assumptions too.
Yeah.
Since you're talking about retirement age, like going out further, are you changing the target date funds accordingly?
Well, we have to talk to the investment guys on, I know, well, I'll say this. I know investment, firms, mutual fund firms who have target dates, they're always looking at that stuff to see, did they change the glide path, right,
Right.
for retirement, but I'll let these guys talk about it.
Yeah, I don't. Great, go ahead.
Yeah, so Capital Group has a large target date fund team that we'll talk about in performance, and they do review the glide path and how it's implemented throughout. One of the recommendations we were going to make when we discussed performance was to have them in sometime in 2024. It's been a little bit since they've reviewed their series with the board, and I think that it's a good time to have them in to discuss it, considering the majority of participants in the plans are invested in the target date funds.
The next big frontier is, you probably all heard retirement income, the idea that people are living longer post-retirement, so now we have to make those dollars stretch out for a longer period of time. From our perspective, I think Britt would agree. Nobody has gotten it right just yet. There's various options. Some of them are tied to annuities, some aren't. It's still kind of a work in progress. In a few more years, I think we'll see some advancement there, but that's kind of like the next big step in retirement planning for these types of plans.
Yeah, it's taking the target date approach from how do I get to a certain number?
Yeah.
To now, how do I manage that through retirement? How do I make sure that? And potentially doing things so that fixed income that you're talking about is getting a
That's
better
when you want a
return.
longer duration after you.
Is getting a better return.
When I retired, they had some 20-year bonds and they already matured.
I had no bonds, Frank.
14% plus. Yep, any other questions? No, anything else you'd like to add?
No, I just thank you for your business. We appreciate it. We appreciate the faith you're putting in Empower. And anything that we can do, help you and this committee, we'll be happy to do so.
Excellent.
All right,
Thanks,
thank you.
Brennan.
All right, thank you.
Thank you.
Good night, all.
Thank you.
Thank you.
Safe drive home.
Thank you.
Anything without him in the room, how do you feel dealing with Empower?
I have had no problems with them. He has been very responsive. There's also another gentleman, RJ, I think it's Nowak, NOWACK or K, RJ, sorry, who also is very, very responsive. And there are two contacts. I typically will, RJ got, Brendan gets involved. But as far as from a responsiveness, we haven't had any issues. Obviously, we had some turnover, so we had some questions. So we were a little bit more of a needier client these last few months, I think, than we probably were before. And they've been very helpful in setting up team meetings and providing us with the information that we needed.
By the way, I should have asked if we could go to executive session before I asked you, only because he could go online and find out what you said.
Yeah.
Which is one of the reasons why I'm not a big fan of this. Britt. Hello, did we got them in 2020, right? Didn't we all, you, the three of us? And is that a 5-year contract?
Yeah, their contract ends, I think, February 2nd, 2025.
I mean, and what do we pay them? How many basis points a year do we pay them?
I do not have that information. I can certainly try to get it from Brendan to see what the annual fee has been. I will say that one of the additional ways they're compensated is that managed account service. So even though that's not in the city's fee, 50 basis points on $3.5 million is probably equal to or more than what the city pays for all of the administration of the plants.
There's been such a consolidation in that business as well, the record keeping. I mean, Empower is a behemoth at this point, which is why it's so important that the client service team, because those are the ones you're really dealing with day in and day out, like, and that's the key in my perspective. It's really
Not as easy as switching a manager.
No,
Untangling this is,
Yeah, that was a lot of work.
yeah.
It was a lot of work. We spent a lot of time doing it. And we had, and Rick did an excellent job in this, helping us with that search. By the way, one of the things too is when you look at these numbers,
Mhm.
remember, there's people who are, like, people in the school board. They are in this plan, but it wouldn't show in Empower that they have money in other plans.
Yeah.
Because I think what we did, to give you a little history, what we did was the city itself had like 7 plans.
Yeah,
Or
it was
somewhere-
for me, but I think there were a large number of.
And
yeah.
what we did is finally said, no, we're gonna combine them, and we did that because then it's easier to get somebody to run 60 million than 6 million.
Yeah.
So that's what we did, but then we looked, I was good friends with, at the time, the person who was the chairman of the school board, and we met, and I talked to him. And they had like 11 plans, and we had enough to go through to get the city plans without the school board plans. So it could be, so I guess what I'm saying is it's a little deceptive, because somebody could be in the school plan and there could be $50 million there. and-
Yeah, if you're saying.
And it's not showing.
Yeah.
So that's why it's, and I don't know whether we want to take on that task to try to.
No, but comparing that though, to those that are getting pensions today. And the woman that worked for, was it 18 years, 20 years, and she was making $40,000, and then she's getting a pension, and then a lot of times people look at this,
$25,000 a year.
yeah,
That's less than 68%.
Oh, yeah, I mean, yeah, her pension, she was getting 14,000 a year. Less than that, just, 15,000 a year rather, and so, that, of course, that's part-time work because school's closed in the summer and stuff like that. And I'm not even sure whether the new employees there are in defined benefit or defined contribution. I think most everybody is, except police and fire.
I know some of the city, some of the longtime city employees also have other plans. For instance, Equitable is a plan that is still, we do have some employees who didn't transfer for whatever, they're contributing to Empower, but they also had the other plan too. So there is some of, from some of the employees who've been here for a
They
longer.
had those annuities.
yeah.
Yeah, there was a
Yeah,
lot
that's
of
a-
legacy assets that couldn't be transferred in.
So just as far as when you're looking at total retirement, there are some employees who have
Right.
things other than in their Empower account.
Yeah, I just wanted to point out the fact that it's not as dismal as it looks.
yeah.
And I
Okay.
would also like to say, especially if you live in Fairfield County and you own a home, you should update the price of your home. Because
Right.
the prices have gone skyrocketing. So they're probably reaching their goal on their home alone.
But you can't eat your house.
True.
Yeah, where are you gonna go?
Yeah. But I'm glad by the way, I wanted to make sure, I'm happy that you're here again, Eileen, because it's great that you're here. And also especially with this, because you're the one who deals with the workers here, the people who are employed by the city, Tina, you too, and we want to make sure that people are satisfied. Because
Yeah,
we don't want it to go through another search. Anyways, anything else anybody wants to say?
Yep.
Then is there a motion for adjournment?
Do we have to go through, were there any minutes we had to go through or?
Did you want to look at the performance report?
Performance report.
Oh,
Yeah,
sorry,
yeah.
performance report.
Yeah, Britt's gonna tackle that one.
Yeah, I'll be brief, given Brennan's overview of the plans. I'm not sure which tab in the materials, but page 25.
5, it's tab on 3.
Thank you.
Of the DC plans report. So just, again, this is as of 6:30, given the meeting frequency for the DC committee, it's quarterly, and this is the most recent quarterly report that is available. So the 401A assets, about 14.6 million. You can see that the overwhelming majority are in target date funds, almost 13 million, or 89% of those funds. If we turn to page 28, to your question earlier, Frank, about what are participants doing in terms of new contributions, and the bottom chart on page 28 shows kind of the history of how participants are allocating new contributions. You can see there is some fluctuation quarter to quarter, but overwhelmingly, the majority of the assets in the 401A continue to go into the target date funds, which we view as
Yeah.
positive because they're diversified and they do de-risk as participants get closer to retirement. If we turn ahead to page 30, looking at the 457 plan, total assets almost 45 million. You can see negative assets, or excuse me, assets going out of the plan, as Brendan touched on, whether those were departures or retirements. And you can see target date fund assets about 67% here. I think notably on page 33, you'll see the same chart we just looked at for the 401A is drastically different for the 457, which we often see, given that the participants in this plan are much larger and some are much older than the 401A plan. They tend to spread their assets around, and you can see stable value, which is the light blue, is typically a big component of 457 plan contributions. In terms of performance, on page 35, you can see for the quarter, the Capital Group American funds returned 81 basis points for the 2010 fund, up to about 6% for the longer dated funds. I did want to highlight that one of the Capital Group Target Date Fund Solutions Committee members passed away in late September, Brad Vogt. Michelle Black took over as kind of the principal investment officer of the Target Date Fund series, January 1st of this year. But the committee that includes Michelle and did include Brad. So unfortunately, he passed away. We think the team is certainly resourced to continue, and Michelle is positioned well to continue to manage the Target Date Fund series. But as I mentioned, I think it is a good time to have them come in and do a portfolio review, perhaps at the next DC committee meeting, just given the level of assets. In terms of performance, I think, the nearer dated vintages tended to underperform their indexes and peers, while the longer dated vintages outperformed both their indexes and peers. And a lot of that is the portfolios tend to have a quality bias. I mentioned it earlier in the pension meeting. So the early dated vintages tend to have more value in their equity exposure, while the longer dated vintages tend to be more growth oriented in how they're implemented. And you can see that's done really well for the longer dated vintages, but is detracted over the quarter and year for the earlier dated ones. Longer term, the series has done very well. You can see, including 2022, where they were down, ranked very favorably versus peers, and longer term continue to do well. So no overarching concerns in terms of how the target date funds are performing.
I get a question. I mean, your Callan target date, this American fund has outperformed every 5-year increment.
Yeah, it's pretty impressive.
Yeah, I mean, is that impressive, or you guys just got a
No, it's very good, but they're also very equity heavy.
No bonds.
There-
Since we're joking about this.
No wonder Frank recruited you.
If you go back, to page 28, the bottom historical allocation, in 2023, there's not even any blue for fixed income.
The
It's
wind's,
below 2.5%.
the wind's been at their sails, so that's, they've capitalized on that, particularly domestic equity, and so it's been a really nice run for them.
But is that unusual? I mean, like, I don't know, how do you get the target date, the calendar target date index? Is that like?
It's
Something
essentially the median peer. So of all the
Okay.
target date fund series out there, how did the median peer perform?
Okay, thanks.
Just out of curiosity, do you track the mixed bonds and equity and the alternative investments for each of the different targeting categories?
We
I'm
do,
curious,
so
uh,
starting on page 43,
It has that?
yeah, so pages 43 through probably 75, 80, break down each vintage of the target date fund series. So you can see, if we take, for example, on page 49, so looking at the 2010 fund,
This is just capital groups.
Yeah.
this
Are
is
you
just the
asking about the
one
peer
fund.
group?
You can see at the top, they have about 30% in equity, about 60% in fixed income, and a little bit in international equity. If you look at the chart in the middle, you can see how they're implementing each of those asset classes.
On the left-hand side are those younger participants.
Yeah.
Further.
And
from
as you
retirement.
go further into the book and you get to the longer dated vintages, you'll see the fixed income allocation come down significantly and the equity and risk asset allocation go up significantly. And I think one page that kind of highlights how Capital Group thinks, and I think it aligns with Brendan's presentation, is on page 43. So the top chart shows how much equity is in the glide path based on the vintage that you're invested in years to retirement. The blue line is the median peer, essentially, the middle of the road of all the investable target date fund series out there. And you can see that Capital Group philosophically believes that the portfolios need to return more and generate more return. So they have a higher allocation to equity versus peers, which they think in the long term will help participants save for retirement.
Good, yeah, that's what you expect also.
One thing I found interesting, if you go back, all the way back to page 30. Yeah, if you look at where it looks like there's a bubble of people that are targeting retirement in 2030. That's the biggest single category there,
15%.
yeah. Does that surprise you, Tina, does that reflect the demographics of our employee group? I mean, the other groups that are collectively more.
Might be
but it's the
worth
biggest-
asking Empower for the ages of the participants in the vintages, because I know I'll speak for myself. I'm invested in a more risky a longer dated vintage than my retirement says I should be, because I think I can take the risk. So a lot of times participants maybe they feel that they want to be more conservative. There could be some rhyme or reason for it, and there could be not. But
Or
we can
maybe
reach
they
out
picked
to-
2030 10 years
Just-
ago and
yeah.
have never adjusted it. Right?
It might be
Well,
30 years. They would
if you
be-
pick a target date, why would they pick 2030, if they're.
Oh, right, yeah.
They only pick 2030 if they're like.
More
50 years
conservative,
old,
yeah.
That's
Early
it, yeah.
50s now.
Yeah, that's
But
weird.
almost everybody everybody in the defined benefit would be able to retire then. Right?
Oh, yeah, maybe that's what it is,
That's one of the things I think would happen is
yeah.
then at that time, everybody's got their 20+ years.
Yeah,
So,
might be something to look, watch for.
Yeah.
I mean, that might be the,
A lot of retirements coming up.
right, that might be the bubble there,
That could be, yeah.
you know.
Well, wouldn't that be in our actuarial report? Where they expect the defined contribution, not this group.
But you would probably have that info too.
I'm sure I can, yeah, we can
Yeah.
pull it.
Yeah.
That's one of the things that I think, going forward, we want to be better at is projecting, obviously not forcing anyone out, but projecting retirements, both for vacancy purposes as well as for financial reasons.
Well, it might be interesting that, Power could probably do a report on
Yeah,
that.
so that's
you know,
interesting about 2030.
Target date retirement versus people's
Yes.
ages. And see if it
Yep.
makes sense.
When did they change before? Because do you remember when we did Gut and Power? One of the ways we paid for the, taking over some of the, we had to pay for some of the annuities.
Right.
And we used the money that came back to the city for people who left,
Okay.
right?
Right.
So, but now you said that people are fully funded after 2 years.
Well, they're vested
Of
in
the
there,
invested in, so they get all their money back plus the
plus
city's
what the
money?
city has.
Okay.
contributed.
Yeah, that's different than, did they change that recently?
If that's, so I've been here since May of 2022. It was like that when I started,
Well,
so
you-
I'm not sure.
Don't confuse defined benefit with defined contribution, so that,
Right, to
Defined
define,
benefit.
no, I'm talking about, right now, everybody's going into defined contribution.
Yeah.
But you're funded after 2 years now,
Vested at, yeah.
You're vested after
in
2
your
years, where
contribution.
before it was 5 years, remember? So I'm
for
glad that
the,
they've
for the
changed that.
defined benefit,
No,
No,
No, for this.
oh, for this
No,
too.
Yeah.
but the,
Okay.
you
Pension,
take
you
5
have to-
years for the city contribution to be vested.
right, and now it's only 2 years.
Okay,
That's a
when did
good
that
change.
change?
I don't know. I can find out. It was pre-May, but I will find
Yeah.
out.
Okay.
Okay,
All right.
any other discussion?
I had one, I'm out of order in the sense that it's a manager in the pension plan. Britt reminded me, one of the co-founders of Silchester actually passed away in September. Mark Cowan, I believe his name is. He was obviously heavily influential in that firm, the build out. They had done some work on the succession plan back in 18 or 19. Essentially spreading out his responsibilities as well as the other co-founder. So they don't believe, and given their process, they don't believe that this is gonna, detrimentally impact the plan, but just something of note that I forgot to mention earlier.
We discussed that when they were in.
Yeah.
Yeah.
We asked that question. They were very forthcoming about their.
Was that the gentleman who came to? Because we did have somebody a number of years ago, an older gentleman, I don't know if that was him.
No, they have they have an investor conference in New York coming up in the spring. And just throw that out there. We can, if anybody was interested, in hearing them, if they're local.
He's gotta be, because he's the one who keeps telling us for more money than we do. It's been. a
I
good-
went to it pre-COVID.
Their
It was a
decision
good conference.
process,
Yeah, they're good.
their decision process was what I found so unique.
Yeah.
The other thing is, do you get it? I get a monthly report, do you get that? From Silchester? No.
No,
I can forward it to you guys.
Yeah, I just saw an email come through, so I'll bring it to everybody's attention. I don't know why it wouldn't be open to all investors in the strategy, you all, so.
Historically, we used to get a report from every single manager every month,
Right,
every board member, and now we don't get any.
I get something from Silchester, but you should contact Silchester and ask that everybody on the board gets it.
I think so.
Gets the invite.
No, it's
Their monthly
The-
report.
a monthly
report.
report.
Yeah, and
Okay.
we can certainly do that for every
We can do-
manager if desired.
Yeah.
But
Yeah, yeah, that's fine. A lot of
Don't
our
overwhelm.
clients tell us not to do so.
is there an opt-out?
That's right.
Is it one click off?
They all have an executive
Unsubscribe.
Yes, yeah, well, not all of them. Sometimes it's tough for us to even get reports from some of them, believe it or not. Yeah.
As long as there's a summary, it's not.
Okay, we're getting close to 8 o'clock, so is there any other business?
Motion to adjourn.
Is that second? All in favor?
Aye.
Tell your brother.
Thank you, everyone.
Thanks,
Thank you.
everyone. Have a great night.
Thanks. It was good.
Good session.